right, Justin. Well, we're back for another week. We're going to keep on this private market theme. Like we suggested last week, we're going to go from venture capital, where we spent a few weeks talking about the nuances, how to do due diligence, etc. And we're going to move today into private equity. So we're going to spend a little time on this. I think it's a confusing part for a lot of people. How do you differentiate between the two? There are certainly some differences, return profiles, types of companies, all these types of things. But then there's also some big similarities. So we'll hit on those a little bit as well. But yeah, Justin, let's start there. Let's dig in, maybe to start super high level. We've talked about venture. What are some of the differences with a private equity backed company, a private equity deal, private equity investors, really high level? Give us the rundown.
Yeah. Well, at first I would say that venture, let's call it VC, just to keep things short and sweet. It really is truly a subset of private equity. Let's define private equity. Private equity is, as the name suggests, the ownership of a non-publicly listed company. It's a private company, right? Private markets. We talk about all these terms time and time again. And venture capital fits within that definition. So that's one similarity you mentioned, but you've also touched on a lot of the differences, and to go there, which is where your question went, is let's think through what those are. So stage of the company is probably the biggest true differentiator between typical private equity, or the standard definition of private equity, where we're not talking about venture, and true venture capital. And what stage is that? Let's go there. It's earlier stage companies that are trying to get off the ground fall into that venture capital bucket. Whereas private equity, typically speaking, these can be very, very mature companies. In some cases, they've been around for decades, multiple decades in some instances. So that's I would say, one of the biggest differentiators. Now, just getting a little bit into the weeds on the current marketplace, those definitions and people who call themselves traditional private equity shops versus people that call themselves traditional venture capital shops are starting to bleed into one another. And you're seeing that at the later stage of venture and more of the growth stage within private equity. A lot of overlap there. And even to get a little bit more inside baseball, some hedge funds as well getting into this space. Tiger Global is a big one. Although, yes, they've gotten into it, but their returns have suffered quite a bit recently. So I'd say stage being the very, very kind of, tip of the iceberg, key differentiator between the two general broad-based buckets. One other thing I'd say that falls into this kind of pure standard differentiator too is the type of the company. Private equity, you're going to see private equity firms and funds be incredibly well diversified. They'll participate in such a wide range of industries, whereas venture capital typically is tech oriented. Although now, the common adage, right? Tech is eating the world, or every company is a tech company now. Whichever one you want to pick, it also kind of speaks to venture capital going much more broad and focusing on a number of different industries, but with that kind of that initial layer, initial motivating factor being tech focused. So yeah, I think that's a great place to start.
Yeah, I think the crossover is super interesting right now too. We see the big, because a lot of times private equity firms come in, for instance, to take a public company back private. And so the most recent, right, is Twitter. And we've got this cross section of, we certainly have venture capital money in there. We've seen that kind of publicly backing Elon. We've seen private equity money kind of involved in that process as well. So you have those worlds colliding in a type of deal like that. And I think it's really good the other good nuance to make here is stage of company doesn't always mean funding size either, right? So this private equity world is so big, you may be taking, it might be a multi-$100 million type company, and maybe they are getting ready for IPO or doing some different things. And you'll have the private equity folks come in because it's a more mature business, operations are established. But maybe there's some tweaks. You'll hire one of these really strategic private equity firms because you're a consumer play and you want to attract a certain market. But then there's also the other part of private equity, right? That's more quote unquote middle market. And so you're looking at companies that might be more regional based. Maybe they've been ran by a family for 50 years and now it's time to transition. You'll typically see private equity shops come in and really help in those transitions, get a new CEO in place, kind of optimize things, right? And so I think the other part, right, to maybe hit on is return expectations or profile. Those are going to be quite a bit different, right?
Yeah, wildly different. Targeted returns are close. Venture capital, depending on the stage, earlier stage, let's go there first, has a much higher expected return. You're taking a lot more risk investing in a seed company, a seed stage company, which is in many cases just an idea, versus a later stage, series B, C, D, where there's a business model there, there's revenue. So sticking with venture capital, right, the typical expectation is that the majority of investments actually fail. The same is not true with private equity. There's going to be a little bit more concentration within a typical private equity portfolio. However, the expectation is that most of those companies, if not all of them, at least return what their investment was. There's no expectation that, hey, we're making this significant investment and this thing's going to be a flyer and maybe it's going to 10x, but maybe it's going to go to zero. That same concept just doesn't exist within private equity.
And I think that's interesting to know. When we're talking to private equity investors and firms, they often provide that analysis, right? We're looking at what's our base case. Okay, our base case is 2x.
Right.
We're looking at our upside case. Our upside case is 4x and our downside case is 0.9x. So getting their money back to your point.
Exactly.
So I think, that analysis is a little bit differently, but at the top end too, we've talked to a lot of venture capital funds, right? If they would never put money into a deal if they thought the upside case was 4x, right? Because they look at deals and want that to return their fund. They're looking at 10, 20, 30x type potential. And they're willing to take that zero on most of the portfolio to get there. So really good point there.
One thing to add to on that is kind of let's call it the source of returns almost. So, and what I mean by that is not so much the early stage, right? Where it's a company that you're incubating an idea. It's a new idea that's trying to disrupt an industry. That's super, super important as well. But from a venture capital manager or a private equity manager, the source of their value add or their returns is often different. Within venture capital, it's very much, hey, I'm a founder myself. I'm an entrepreneur or I'm an operator. We can really help you get this idea off the ground, get the operations of the business really dialed in, build a go-to-market strategy, et cetera, et cetera. Whereas private equity, a lot of it is more, what you were hitting on is more financial engineering almost, right? Or just operational improvements. If it's a family business where they haven't had professional management before, hey, let's bring in that professional management. Let's institutionalize what's going on with the business. Let's bring in a CFO that knows what they're doing. Let's potentially put some debt on the business, which we'll touch on probably in this conversation. And so there's some nuance or not so much difference as you hear me say that, but there is a lot of true differentiating aspects to those true drivers of return, or really maybe the value add aspect is a better way to put it.
I think that you made the point on debt. I think that's interesting. We not often, but you will see venture debt, out there. And so you'll have a debt partner come in a venture capital type round and the growth of a company, a lot more difficult to underwrite, right? The bank, you're not going to have a bank that's going to do too many venture deals. Yeah. So you have these venture lending shops out there that are really established, and typically it's loans plus warrants and all these types of things. I think we've hit on it before, but oftentimes in these types of deals, right, you're having a big bank and they're going to write a big check, especially later stage private equity, and additional element of risk, sure. But it also, I think, points to the size of the deal, right? And entrance. Like the other thing, I was just visiting with a private equity investor in New York this week, and they talked about even the price point to play. You're not going to go in as an individual investor and take out a slug too often in a big private equity deal. Whereas with venture, it's a little more approachable, higher risk. From a dollar standpoint, you can get in trouble a lot quicker. So maybe talk about how do you access the best private equity? Should you be investing in private equity? Kind of give, obviously this isn't investment advice, is very specialized, but, I'm just trying to feel, the lay of the land here a little bit.
The access conversation or access topic is very similar to venture. There is strong evidence of persistence. It's not as strong, admittedly, within the private equity space as it is in the venture capital space, but access still matters. The network, the relationships, the specialty or the focus of the firm matters. And, a beverage company is not going to just go to a random private equity company that's writing them the biggest check. They're going to go to a private equity firm that has experience in that space. With respect to return expectations and whatnot, the overall differences are relatively minor, but if you think about a compounding effect, venture capital still has most definitely the highest expected return. Again, thinking traditional venture capital in this sense, where let's call it the earlier stage, whether it's seed to Series A to Series B, you're expecting a higher rate of return because you're taking on more risk, and balancing those two things is very, very, very critical.
Yeah. And I think to your point, the relationships and the value add, right, still really matters. To win a deal, it's still a competitive market. Kind of, again, this private equity investor I was just with was talking about winning deals, winning access to deals. It's still a place that you have to come in as a value add type investor, LP. They were able to use some of their relationships. They have some athletes as clients, and they were able to basically put together some different elements, go to the CEO and show how they could really help them to gain access to one of the more recent deals that they're a part of. So I think you still have to think about a value add, but at the end of the day too, if you're a company, right, and you're taking on this private equity or certainly venture capital we've hit on, the goal is to reoperationalize some things or go grow, right? We're seeing this actually in our industry a lot right now, where, it's, your loyalties change a little bit, let's say that. Yeah. But if you take on a bunch of private equity, it's something we're passionate about, always staying privately owned, is because we don't want to have pressures to try to make decision making for somebody that's not within our business. And so we want the people that we work with to own our business. And it allows us to make, in our opinion, more strategic decisions. I'd love your thoughts on that. But I think just what are some of the pressures that come if you do take private equity?
Well, they're making the investment to turn a profit. And generally speaking, it's a relatively short window. There are very few private equity firms that are making an investment for the true long term. And within our space, we use that term quite a bit. And long term being 10, 20, 30, 40, you could even argue 50 years in some cases. So it's a very long period of time. When you bring in private equity money as a company, there's going to be a relatively short-term window in which results need to be generated. They're investing on behalf of firms like ours, and I didn't answer your question specifically about whether you should invest in private equity. And to your point around,
it's a good dodge. You should dodge it.
Not investment advice. It's an attractive space, and we do, just by way of investing in the private markets, and whether it actually falls in the definition of venture capital, et cetera. That's probably a whole nother conversation. However, we as investors make that investment and have an anticipated hold time for the fund or the direct investment, and the managers that are managing the money or bringing the capital to the company are communicating that back to us, and then they're putting pressure on the management of that specific company. So, roundabout way of answering a couple questions there. in our industry specifically, it's really important for us to stay truly private and independent because there's just a huge conflict of interest between having a new overlord, if you will, driving certain metrics that may be completely detrimental to long-term client success. And we just, really don't want to play with that game.
Yeah, no, it's top of mind for me. I was just with a bunch of different advisors back east and talking to one of them, and unfortunately, they're part of one of these firms, and you just see the changes and the frustrations, right, that ultimately come out. And it's not good, bad, or indifferent. It just happens to be the right decision for us to not take that on, but just acknowledging the pressures for these companies. So it is there. You're supposed to grow. You're supposed to go acquire other firms if you have to, or do what you need to do to make it happen. So both venture, both private equity, it's about growth. At the end of the day, it's about profit and reorganizing everything, because people like us on the other side want a return for the money that we're putting at play. For you guys that are listening here, we want to make sure that you get the best opportunity for returns and exactly the returns that you deserve based on your financial structure. So, I think that's a good place to kind of wrap up for the day. We're going to shift gears again next week. We're going to stay in the private markets. We're just going to get into private real estate. So probably everybody's favorite topic. We left it for last because we know people love real estate, the tangible nature of it. And hopefully through our coaching, we try to show that, private equity and venture capital and investing in the public markets is tangible as well, but there's a knack for real estate. So we'll get into that next week. Some of the things you should look for. Again, risk return profiles will blow up the notion that real estate always goes up. Spoiler alert, it doesn't. But at least in our lifetimes, it seemed to have. So we'll close out there. Again, I should have mentioned this at the top, and I'm going to start to do that. But I'd love to hear from you guys. Shoot me a text. It's coming right to my phone. Justin and I will get back to you, but we want to know what questions you have. So hot topic next week, real estate. Shoot us your questions. Let us answer them. Phone number is 602-704-5574. 602-704-5574. And until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.